Happy New Year if you missed us on the last one. And I do apologize for everybody else who has registered at our past events. I know we've been hopping around 2 different platforms. We're back to our original one. I know some of you didn't get the link, but that's okay. We have your email. We'll make sure you get a copy of the recording and it'll be available to you. So we sincerely apologize. But going forward, we're back to our original platform where we started. As they say, sometimes when you get proposed with new shiny light, the shiny light doesn't look as good once you get in. And we ended up discovering that. So goes without saying, we're excited today, once again, to have another great discussion on blockchain and tokenization, and then obviously the private capital markets. But before we get started, I want to thank, obviously, our sponsors, Nuvi, who have been very supportive of the KoreSummit series that we have. They're a global payment processor in over 180 countries around the world. They're also NASDAQ publicly traded. So thank you to Nuvi. And of course, CoreChain, one of the first blockchain companies that has gone through the process of being SEC qualified for their blockchain technology for digital securities, NFTs, and security tokens. All right. So today we are, Karan and I, Dr. Karan Garimella and I are going to have an interesting discussion regarding 3 hot topics. Tokenization, it's a big, so we're going to unravel that. The private capital markets, and why is there so much confusion around this? And I think that's the part that we're really going to harness on today. Hopefully we won't get strayed off too much from our discussion, but the idea today is really to make sure that we have a really good understanding what each of these elements are. So, and this is an important part. I'm going to break it down because I'm one of those individuals that likes breaking things down into buckets. So tokenization is a technology. So that's tech. Private capital markets is a regulated environment. And then we're going to talk about the confusion. So it's amazing when you break it down into those 3, how hopefully maybe the confusion isn't so confusing. But all right, so let's get started. So Karan, let's just get started. I mean, before we talked about blockchain, a little bit what it is, but let's talk about what is tokenization. Give us the basic and the, obviously what everybody else is reading, because it's the big buzz. So let's hear it.
Yeah, I know that is one of the most confusing concepts. It sort of sounds very simple, but it can be confusing once you get into the details of what tokenization, what are tokens, right? There are so many different types of tokens, and people ask, why do we need tokens anyway? We have something called shares and securities in companies, right? And to kind of give a context to this one, if you look at a traditional company and it wants to raise capital, it creates what is called shares, equity, or perhaps bonds, but just let's stick with equities like shares. And it sells these shares to investors, whether in an IPO, a public market, or a private market, doesn't matter. Shares are shares, right? And, in the past, there used to be paper copies of the shares and paper certificates and so on. But nowadays, we create electronic records. So what's different about electronic records and shares versus tokens? So every share in a company stands for the whole company, and then you kind of break it into units. So there's a fractional ownership for every share within all of the company. Tokens are somewhat different. They offer much more flexibility. So you can actually create tokens to stand for certain asset classes within a company. So a company may have goodwill, it may have inventory, it may have real estate, it may have so many different things. But when you buy shares, the traditional shares in a company, you're basically buying all of that in some sort of a package. And you have to read through the financial statements to figure out, how much of the desk chair in the company do you own and how much of real estate do you own and things like that. But in tokens, you can say, look, I will take all the real estate in my company and bucketize that and create an asset token out of that one. And let's deal with that separately versus the goodwill or something else, or maybe in a different geography. So you can create all those really interesting things. But the other important point, Oscar, I think it's all opened up, is it allows people who are not in traditional finance and don't have the traditional financial machinery to benefit from using tokens. So tokens in one way are simply securitized assets of a certain class, but they offer a lot of flexibility and functionality.
Agreed, but we've also seen where it's not just being used. So I just want to make sure for the audience they understand that tokenization. Obviously, this topic is regarding the private capital markets, but in general, tokenization is being used in other contexts, right? People have been hearing tokenization of art and music and other
Yes.
things. It's not just physical art; it could be digital components as well. It's a representation of something else, and I think where the line gets crossed in tokenization, and we're going to cross that.
Mhm.
Hopefully, if maybe we'll bring it up some more, but I just want to make sure the audience has a really good grasp of what tokenization is, because I always feel that it, it, uh, it people often speak of tokenization in such a way that everybody knows, and it's we know that what it is. It's actually sitting on it's going to be sitting on top of blockchain itself is going to create this token. So tokenization, this token can be fractionalized, it can represent a real asset, it can do a whole bunch of different things, and it can also be connected to a smart contract, and it can have a whole bunch of different rules. And the whole thesis behind tokenization in the market, just for everybody else, is, and you see it, it's supposed to be transparent and it's supposed
Yeah.
to be lower cost.
Mhm.
So I want to make sure we cover one thing about, let's talk about transparency. So it is transparent. You have to be very technical in nature in order to get to that. And as you know, if anybody's ever been robbed before, your wallet, or you've been scammed, getting that, this is the IRS, send us $500 and so on. You all know that people disappear very quickly. So want to make sure we're all clear that as much as we've been it has these attributes. There are, like any other software program, workarounds that not everyone in the industry, but those that know how to manipulate this can. So we have to be very careful with that. Lower cost, well, that's debatable, and again, that depends on the type of blockchain you use. So it's really important that not everything gets classed into one thing and says, yeah, this blockchain, it represents all of that, and ooh, we're ready to go. Each one has its pros and cons for tokenization, and it's important people classify that. And so here is the part that where I come in, where's the bridge where we go tokenization, private capital markets. Really simple. It's really simple. Is the expectation from you, the individual, when you buy the token or you invest in the token, whatever term you want to use, is the expectation for you to have a return on that? And a return is, I bought it for $1, I hope to make five. I bought it for $1, I'm going to sell it for this because it becomes an investment, and two, there's an expectation from your end, that it's going to gain in value.
Right.
And there's a reason I'm making this really important reference point, because in the early days of when tokenization first came out, in the
Mhm.
early days, the argument was, Oscar, come on, tokenization is just like air miles. And I go, no, it's not. Yes, it is, Oscar. Look, I can earn a point. Why not call it a token and see it? And it has a representation. So this is the difference between air miles you get from your airline, your hotel, your store, wherever. Today we're all getting bombarded with points. And why isn't the SEC going after them? Because when they give you those points, there's one thing they do not do. They do not tell you the par value of that one particular point. What they tell you is the following. They say, if you have 7,500 points, I'm going to give you, you can get a book, a chair, a glove, or a t-shirt. You pick. Each one of them to you has a different value. To some people say, hey, that shirt's worth 100. And then over there, that air ticket is worth 400. It doesn't, whatever value, but they're not telling you what the value is. You're picking and choosing. And tokenization is different. Tokenization is actually putting a par value on that particular token, And
Yep.
not only that, it can fractionalize it, and it has a value of representation that regardless of what you're buying, that word it's worth 100. I got to have 100 of these in order to buy it because it's one token in order to get it there. And I think this is where we now move over to the private markets, right? Tokenization and the private market. So let's talk a little bit about that. You started talking about it, shares. So why is this so important? Where is the benefit of tokenization and the private market? We know what people are seeing, but where is the true value in tokenization?
I mean, there are several, right? One of the most important things is that just that very simple concept of tokenizing something opens up the flexibility and the ability of companies to create tokens for various things in different forms. So that's number one. Second, it offers a level of transparency that was not there before. The third piece is that this is, of course, backed by blockchain. It is very dependent on blockchain technology. So all of the transactions become very immutable. So they are there on the blockchain. They're widely decentralized in many cases, or at least widely distributed in many cases. And of course, now there are secondary trading platforms on which you can actually trade. You don't have to go the route of the NASDAQ, the NYSE. That's an entirely different ballgame. Now you have entirely different ways of doing this, right? So there are a lot of these benefits that you typically will not see in the regular share markets. And of course, the other big part is the fractionalization. I mean, you can own a very, very small piece of Mona Lisa, if they tokenize something like that, which, most Main Street America cannot, own something like that. They cannot make those investments. So we're seeing a sea change in the number of people who can now participate in markets. And so we have to leave the public markets around and just look at the private markets. I mean, this is all private markets, right? So that's kind of where I see a lot of these benefits, Oscar.
Okay, well, I mean, that's interesting. You're seeing it from the front end. I personally have seen, I know people use the word tokenization. I'm going to come back to blockchain. I mean, anyone who spent any amount of time in whether the public or capital, and you've had an insight into how it operates, you clearly start seeing the inefficiencies. Look, everybody who's listening in today, you experience inefficiencies all the time. Number one place you go to is when you want to get your passport renewed or you want to get your driver's license renewed. You're standing in line there and you're going, come on, with all the technology. I mean, who hasn't done that, right? Who hasn't actually sat there? So that's common sense. So the more vertical the business becomes, you only see the surface. But the real value in tokenization, blockchain, and the private markets is understanding what it takes to take a transaction from A to Z. And so and this is where the confusion starts coming out, is how do you get a transaction from A to Z? So first you need to map it out in the traditional sense to make sure that you've covered it all. And then only then can you then apply that to the tokenization and see the true benefits. And the benefits are definitely there. There is no doubt in my mind that using blockchain and tokenization in the private capital markets is a transformative event in how the private markets will evolve. Case in point, I mean, we can't attribute this yet to the private to blockchain, but it's going to come. We're seeing more visibility of private companies than ever before. I mean, 10, 15 years ago, it was only a very small number. We saw now the numbers are growing and growing, and it's only going to get better. So no different than the public markets has the visibility, the private markets can do the same, but we have to do it in a very different way. We cannot rely on the infrastructure of the public markets. The public markets infrastructure has a limitation. If anybody has ever noticed, at no given time in the last 30 years, there has been more than 100,000 publicly traded companies.
Exactly.
People go, there's IPOs going all the time. For every 10 that go up, 10 go down.
Exactly.
And numbers have never changed.
And here's another part too, right? The account. So you said the transparency for in the private markets that's growing up, the scrutiny is going up, but it's also the accountability. people are being held accountable. So in the past, the private markets were deemed to be like totally private. They can do whatever they want. That whole narrative is disappearing now. You're actually seeing a lot more holding the feet to the fire accountability from the SEC, the FINRA, the FinCEN, so many other of these organizations. And I think that's been a big change as well.
Correct. It's
So
the
yeah, no, please.
No, I was just going to add, look, it's, I mean, we're, as I said, the question is, what are the benefits to the private markets? It's from the front end, it's providing the transparency. It can, I just want to be very clear. I'm using the word can because there is a fundamental element that we need to deal with is that, you know, not all blockchain technologies are the same. So people need to be wary of that. Don't use it as a generic word. So number one, tokenization is great. You can do a whole bunch of different things. The second one is there a benefit to private markets, for putting different assets, real estate or
Yeah.
venture? Is there a benefit to the investor? All of these things are great. But again, there's another question that needs to be asked at the very end. And that's to say, okay, depending on what blockchain technology you use, because this is going to be important. So the benefits are great from an investor perspective. I have an immutable ownership. I like that. It could potentially offer a faster liquidity. And I need to be, this is an important word here. It could potentially, because look, after all these years, it's been 4 or 5 years, people are still trying to figure it out. It's still not all there. Why? Because when you take the traditional path and you understand all the different pieces regulators want you to follow. Now you're hearing that word. Now we're going to use it now more in our context. Regulators. This is the third piece of the puzzle that everybody overlooked or said, hey, the regulators will just have to follow because this is the new way. Technology leads it. And we obviously know now that's not going to be the
That's
case.
how it is.
So
That's
that,
right.
and that's where the confusion has been when you see all the benefits, you see the benefits of tokenization, how great it can be. You see the benefits to an investor from the clarity, for the transparency, immutability, and potential liquidity. And then the big question comes up, then where is the stumbling, where is the hiccup in all of this, in the market, the confusion, and where are the additional benefits? So let's talk a little bit further on the benefits. So we talked about the investor side. Let's talk a little bit more about the as in overall from the A to Z on the private capital markets. And I know for some, yeah, we're going to unveil it for you because I think most people don't realize that when a company chooses to raise capital, it one, the company needs to be a legal entity, number one. Number two, the likelihood that the company will have a lawyer is pretty high and an accountant or auditor. Number three, the company will have to file in order to raise this capital. So the United States in particular is has great regulations for whether the company is 1 day old or 100 days old, for 10 years old, it doesn't matter, to follow certain regulations. You have certain
Yes.
regulations that say, if I use this regulation, I can sell my securities to anybody over the age of 18, and I have a limit on how much they can invest, and I have a limit on how much I can raise. So the rules are there. So
Yeah.
now you got the participants, you got the rules, and then the rules tell you who you can work with. You got a FINRA broker dealer, you need a bank for escrow, you need payment rail, you got IRA custodian. You see how the ecosystem just keeps growing and growing and
Exactly.
growing. And here is the clarity in all this. That entire ecosystem is regulated. Each one of these lawyers are regulated by the Law Society. Auditors are regulated by their society. FINRA broker dealers are regulated by FINRA. The issuer and the investors are regulated and broker dealers by the SEC. IRA custodians, registered investment advisors or IRA, everything has rules and regulations to protect who? The investor. The
And that's
investor.
yeah, and that's the important point, Oscar. I think many people miss that. I'll give you a simple example: liquidity, right? They'll say, it's been like 5 years. Where's the liquidity? Well, you know what? They're comparing the public markets for liquidity. Those took more than 100 years to develop, right? It's been a very, very long haul for them, but to the time you can get here. So this whole question of protecting the investor, people misunderstand that. They think the regulations are there, they're very bureaucratic, they're very constraining. So, Oscar, we talk about this a lot, where we face some people come to us and say, oh, we are going to set up shop in, some other foreign, country, Gibraltar or someplace like that, because rules are lax, it's better for us. Well, you have to ask the question, if it's better for you, is it better for the investor? And sometimes it's not, right? So this all of these regulations are there for a purpose. Now, I grant you, and people make this argument, they'll say, well, there's too many regulations and it's very onerous. Agreed, onerous. But that's exactly what tokenization and the blockchain is set out to do, is to make following the rules less onerous, more efficient, more fluid in the markets, right? I mean, that's the whole, and at the same time, not losing the excellent benefits that you get from this wide diversification into various asset classes. So I think people need to understand this entire spectrum of the regulations that you mentioned. I mean, they're there for a reason.
Well, and that's just it. I mean, people keep asking there should be specific regulations for this. And the answer is the regulations are there. And that's the confusion. And that confusion has now, that clarity has been spilled out by the SEC over and over and over again. And this is, again, coming back to what I said earlier. The tokenization, not a problem. The SEC has no issue. You want to call it a digital security, you want to call it an NFT, a security token, whatever you want to call it. You can call it boo boo baba banana cherry, whatever you want to call it, great. But here is the rule base. Now, the interesting thing is that if you have no experience in the private capital markets, and I think this is where the confusion also lies, is that most of the participants that have come out only see the high level. Come on, we've got to be able to help companies out. This thing's going to transform. Look how simple we can make it for an investor to invest in the company. Great. But did you do all the other things that are necessary in order to be able to do that? And so, initially it was for everyone. Then it was only accredited investors. And then, it went to institutions. Because what they ended up discovering is that the technology they created would not meet the requirements. So this is one of those situations. And if anybody's ever run a software company or been working for a company, do you try to push a technology into something like a square peg, or do you find the one that fits what is needed? And it's the latter. It's you get your specifications out. This is the rules you got to follow. And can it make it more efficient? The answer is yes. It's just that it's not that product. And for those who are old enough, you may recall way back in the 90s, there was a time, I kid you not, there was a time, not today, but there was a time when companies needed to make a very distinctive choice. I'm either going to use IBM DB2 or am I going to use Oracle? And it was not, they didn't talk to each other. It was a hard decision. They needed to make decisions based on speed, expandability, a whole bunch of different factors. And both companies grew. Both companies grew in their own specific verticals and so on. And then over time, they came for a way to bring it all together. And today we have more than, over a dozen types of databases. My point is, in blockchain, it's the same. There isn't going to be one that rules it all. Public is one way to, public is great. If it's going to be for public records, like for real estate and stuff like that, it may have some purpose. But overall, we're starting to see that when you take the rules that are there, and this is the confusion, you've got to start with a rule base. You've got to start with the process that is currently being done. And if it takes 100 steps, these are the 100 steps. I'm not saying applying 100 steps. I'm just saying that's how they do it today. Analyze it, understand it through and through, and then understand the rules